So this is the same repo situation post-repocalypse. You can see it starts here on the left side on October 2019. So just before that is September 2019. And that is when the repocalypse happened, when repo rates went to whatever it was, 10% overnight. And then the Fed had to act immediately after. You could see at the beginning of this chart, there are no repos. There's no blue lines in that little margin at the beginning of the chart. But then it starts at around September 17th over here, and it's about $50 billion where we are now. It's between 40 and 60. You can see this first bar over here. But we had been above that line following that date many times. It was consistently above 50 billion, not every single day, but pretty much from September 2019 to about December 2019, it was usually above $50 billion in daily repos. It dropped off a little bit in December and then January 2020. And we all know what happened here, the lockdowns of infinite wisdom and compassion. That's what I call them because, yes, they were wisdom and compassion personified in the lockdowns, which saved the entire planet.
The global financial system has recently experienced a significant disruption. What's more, the stress signals that preceded the 2020 money printing eruption are currently in operation. Repo rates are increasing, liquidity is diminishing, and central banks are clamoring to inject emergency currency into the system. The same sentiments are being whispered by traders around the world. This is reminiscent of the year 2019. Additionally, they are correct. Rafi Farber, a highly esteemed member of the gold and silver community, cautions that we are currently experiencing a recurrence of the apocalyptic moment, during which the entire banking system nearly halted, compel the Federal Reserve to print trillions of dollars, and initiate the most significant inflation wave in modern history. However, this time, he asserts, the Federal Reserve is cognizant of its impending arrival. They are observing the event as it unfolds. The potential for gold and silver investors and the repercussions for fiat currencies could be substantial if the next domino falls. Let us examine the current situation and the reasons why Rafi Farber is of the opinion that this new repo crisis has the potential to precipitate a significant revaluation of gold and silver in the months ahead.
An excuse to print money. Some people say it was more than an excuse, and I won't get into any of those ideas here, but you know what I'm saying. This is going to be a very interesting test as to what the nature of the COVID money printing really was, because the same thing that happened right before COVID is happening now. Liquidity is drying up all over the world, and it looks like if 2019 and what happened at the end of that year was a planned operation to print money, something like that is going to happen again soon.
When will then be now? Soon.
If you believe in that stuff. Anyway, let's get into the slides. And of course, before anything very big happens, you might want to take advantage of the recent consolidation in gold and silver prices to get your gold and silver at Miles Franklin. Take your gold and silver that you have and put some of it in a Dirty Man safe. Link in the description below. Use code ENDGAME10 at checkout for 10% off. And if you want a more detailed description of what is going on now in the aorta of the monetary system, check out the Endgame Investor at Substack. Link in the description below. Let's get to the slides. First thing we have is an article from Bloomberg. I think it's from October 31st. The headline is Global Money Markets Are Flashing Signals. Liquidity is drying up. You have a picture here of some guy with a lot of red light on his face with Jerry Powell in the background talking about printing money or whatever it is that he's talking about. This is a picture that is reminiscent of that get off my lawn scene with Joe Biden with these red lights in the background and two guards that made the US look like the USSR for a few months, and it was very scary. This is what that picture reminds me of. But liquidity is not only drying up in the US, it is drying up in the UK specifically as well. Let's see how exactly this is happening. In the same article, with which this is the headline and the headline picture or caption or whatever, this is a chart that appears in the middle of the article. It says funding demand surges to a record. This is talking about the Bank of England. This is the equivalent of 1 week repo surging in the UK. This is how much money is being circulated by the Bank of England to those that require short-term loans. It is nearing 100 billion pounds. You can see this short surge at the end of this graph. This is a sign of liquidity constraints in the UK, which is being reflected in most of the world. Why is this happening? Well, one reason is that the Treasury's bank account, the amount of dollars sucked up by the Treasury, has broken through $1 trillion as of October 30th.
The largest denomination currency ever, a $1 trillion bill.
That is money that the banks do not have, and that is one of the things that is causing tightness in the repo and the SOFR market, the market where banks and other financial institutions trade treasury securities for cash with each other. And if they don't have enough, then they go to the Fed for that cash. Now, this is what is happening now. There's a blue line and a red line. I've shown this many times on these videos, and now we have finally crossed the threshold where the blue is above the red. The red is bank reserves. The blue is the amount of cash being traded, the amount of reserves being traded for treasury securities every day. You can see that we have broken through $3.2 trillion on the blue line, and we have broken below $3 trillion on the red line. So there's more reserves being traded than the reserves that exist today. How is this possible? I don't know for sure. I suspect central clearing of part of that cash flow is responsible, meaning if there is a clearinghouse that is canceling debt between several parties that owe debt to each other, the volume is measured as all those banks paying loans to each other, whereas the debts are canceled out if there is a central clearinghouse. So some of the volume that is being traded does not actually exist, which is why I believe that we are over 100%. I don't think this can continue for long, and this is why. We are already at the stage where the central bank, the Federal Reserve, has to provide the missing cash itself because there's not enough reserves to go around. There's only 2.85 trillion, whereas there's 3.2 trillion in reserves being traded every day now. And that is why some of this money has to be supplanted or supplied by the Federal Reserve. We saw this in the headlines on Twitter and other social media networks a few days ago that the central bank, the Federal Reserve, has printed $50 billion, and now it's printed over $20 billion, and this is huge and it's never been this high. Well, that's not exactly true. It has been this high. It's been much higher. We're going to go to the next chart to show you that these headlines that are saying, or these tweets that are saying that repos have never been this high, not true. I wouldn't say they're lying, but they're being a little bit misleading.
Are you high? What? No, I'm not high. What?
You are high as a f***ing kite.
I'm not high.
So this is the same repo situation post-repocalypse. You can see it starts here on the left side on October 2019. So just before that is September 2019. And that is when the repocalypse happened, when repo rates went to whatever it was, 10% overnight. And then the Fed had to act immediately after. You could see at the beginning of this chart, there are no repos. There's no blue lines in that little margin at the beginning of the chart. But then it starts at around September 17th over here, and it's about $50 billion where we are now. It's between 40 and 60. You can see this first bar over here. But we had been above that line following that date many times. It was consistently above 50 billion, not every single day, but pretty much from September 2019 to about December 2019, it was usually above $50 billion in daily repos. It dropped off a little bit in December and then January 2020. And we all know what happened here. The lockdowns of infinite wisdom and compassion, that's what I call them, because yes, they were.
Rafi Farber commences his presentation by emphasizing the rapidity with which markets can collapse in the event of a liquidity crisis. He transports us to September 2019, the infamous repocalypse, during which overnight repo rates abruptly increased to 10% and the Federal Reserve was compelled to inject hundreds of billions of dollars to avert a systemic catastrophe. At that time, daily repo operations frequently exceeded $50 billion, reaching a zenith of $150 billion in March 2020, just prior to the world shutdown and the inflow of trillions of new dollars into the system. The same pattern is silently re-emerging in the present day. The Federal Reserve's standing repo facility has exceeded $50 billion per day in the past few weeks, while the Bank of England's short-term repo lending has reached £100 billion. These are preliminary indicators that global liquidity is rapidly diminishing. The Fed is not in a state of blindness this time, according to Rafi. It is taking a proactive approach by attempting to prevent breaches from exploding. However, he cautions that preemptive does not necessarily equate to effective. One of the primary perpetrators, according to him, is the US Treasury's substantial cash hoard, which has now surpassed $1 trillion. Every dollar that is stored, there is a dollar that is withdrawn from the banking system. The secured overnight financing rate SOFR is currently trading above the Federal Reserve's own rate on reserves due to the limited availability of reserves, a distinct indication that banks are in a state of financial distress. For the first time in history, the $2.85 trillion in physical bank reserves has been surpassed by the $3.2 trillion in total daily repo transactions. In summary, the financial system is transacting a greater amount of money than is actually present. IFI is of the opinion that this imbalance reveals the same structural defect that precipitated the previous crisis. Built on fractional collateral, a mountain of synthetic credit, the shortage may be concealed by central cleansing mechanisms. However, they are unable to eradicate it. What's more, the Federal Reserve has assumed the role of the lender of last resort, discreetly generating additional liquidity to obscure the gap. And the pivot has already been declared official. The Federal Reserve has announced that it will suspend quantitative tightening QT on December 1, 2025, thereby concluding its endeavor to reduce the balance sheet. This is not a sign of fortitude for REFI. It is a recognition that the system is unable to endure without the consistent infusion of newly printed money. He refers to it as the prelude to the subsequent printing cycle. In the interim, the actual economy is experiencing a significant increase in stress. Office loan delinquencies have reached the greatest recorded level of 11.76%, indicating that commercial real estate cracks are widening. Once prime buildings have been transformed into liabilities as a result of remote work, high interest costs, and declining occupancy. The collapse of property values results in the loss of collateral for banks, which further restricts liquidity. Concurrently, the tangible gold and silver markets are experiencing a surge in activity. The accumulation of bullion by central banks, including those of China and the BRICS nations, continues to reach unprecedented levels. The premiums on physical silver are increasing as investors hurry to secure supply, and mints are reporting weeks-long delays. The price of gold has been stable at approximately $3,950 to $4,000 per ounce, while silver is currently trending toward $48 to $50, which are considered by many traders to be the threshold for a historic breach. Investors are addressed abruptly by Rafi. The liquidity squeeze that preceded the 2020 printing surge is currently being observed. Only this time, it is larger, broader, and more global. No, the system will not be rectified by the Federal Reserve's forthcoming pivot. It will be inundated once more. The value of those who possess paper promises will diminish. A rise in the purchasing power of those who possess real money, such as gold and silver, will be observed as fiat currencies debase. He encourages investors to regard physical metal as insurance rather than a commodity, the sole form of wealth that is immune to default, freezing, or inflation. He serves as a reminder to viewers that history consistently concludes in the same manner. Gold and silver reveal the true nature of money when trust in paper is lost.
Wisdom and compassion personified in the lockdowns, which saved the entire planet. And I won't say anything else about that. So you see here, the record for repos was actually $152.75 billion on March 17th, 2020, when the lockdowns were instituted. So when people say that 50 billion in repos is an all-time record, it's never been this high, it's not true. It is true that the standing repo facility that they have now has never been this high. But there's no economic difference between a standing repo facility and a repo facility that's on the fly. It's all the same thing. Dollars are dollars. It doesn't matter if you're standing there or sitting there or lying there or flying there while you're doing repos. Doesn't make a difference. Repos are repos, and they've been higher. When will this finally spill over into the rest of the markets? Well, I don't know, but I can tell you that the weakest part of the markets that have been the weakest since since Treasuries started to fall and interest rates started to seriously rise when the Fed started hiking interest rates, that is the commercial mortgage-backed securities market. Of course, lockdowns would be pretty bad for those things because when you lock down, people stop going to offices to work and they start working at home, and then that becomes a habit, and then the office real estate isn't worth much because nobody's going to it anymore. Nobody wants to renew their leases. So we have here from TREP. The TREP CMBS, commercial mortgage-backed security delinquency rate, resumed its climb in October 2025, jumping 23 basis points to 7.46%. We'll just read a few paragraphs here. In October, the overall delinquent balance rose 1.1 billion to 44.6 billion. That's about the size of the Madoff Ponzi scheme, which was 50 billion. All 5 of the major property types saw increases in their respective delinquency rates. The largest rate increase was seen in the office sector, which soared 63 basis points in October, which set a new all-time high of 11.76% after retreating by over 50 basis points the month prior. Earlier this year, the office delinquency rate hit new record highs of 11.08%. In June at 11.66% in August, both now eclipsed by October's new peak. So we see office CMBS getting worse and worse and worse. And now that culture has changed and offices are no longer in demand because of the lockdowns of 2020, the wisdom and the compassion of those lockdowns had the unintended consequences of making office buildings almost worthless because nobody goes there anymore. Anyway, one more sentence here. The second largest rate increase was in multifamily, which rose 53 basis points as delinquency rates to 7.12% and topped the 7% threshold for the first time in nearly 10 years since December 2015. So, how much longer until something in here implodes? Can't be long now. We're already at record highs in office delinquencies. Now, there are so many bubbles that still exist because of the money printing of 2020. And the one that I follow closely is actually the Bitcoin bubble. You can't even call Bitcoin really a bubble, and I'm waiting for all the comments below to tell me how I don't understand Bitcoin. Well, that's true. I don't understand Bitcoin. I have no idea what it is. And you know what? Neither does anybody else, because it's not a thing. It's just a code to an empty safe with an empty safe inside of it, and so on and so forth, until you get to the final empty safe, which has nothing in it. But anyway, this is Bitcoin in gold terms, how many ounces of gold it costs to buy 1 Bitcoin. And the high we can see is still back from October 2021.
In conclusion, IFI poses the following inquiry. Is this merely a rerun of 2019? Or are we observing the commencement of the next significant monetary reset? If the past serves as any indication, the Federal Reserve's subsequent emergency measure may serve as the catalyst that propels gold and silver to unprecedented levels. The same cycle that propelled gold from $1,500 to over $2,000 last time could now propel it to $4,000 and beyond, while silver, which has historically been the most undervalued monetary metal, could increase in value even more rapidly. Hold your physical metals close and remain vigilant, as advised by Rafi, because the truth about real money cannot be concealed when liquidity is eliminated. If you found this analysis to be beneficial, please click the like button, subscribe to the channel, and enable notifications. This is because we are monitoring every significant signal that the mainstream media disregards. Now, please inform us in the comments whether you believe that this new repo stress will result in another wave of money printing, or if you believe that the Fed has finally mastered the art of managing the storm. Your perspective may be the critical one that an investor requests. Please share it in the comments section below. Remember, in times like these, knowledge is wealth and gold and silver are its foundation. Stay informed and prepared.